Who owns the real assets? Who owns the equities? Who owns the companies? Who owns the pigeons? In Belgium, they play with the pigeons. Who owns the wine? Who owns the old timers? Who owns the gold, the silver, the commodities? And we will be living in a world where real assets become even more important because inflation is so high. And
hello, everyone, and welcome to another edition of CEO and Market Expert Interviews. I'm your host, Lucian. Some of you know me as Triangle Investor from social medias. Today, I'm joined by Philippe Gijsels. He's the Chief Strategist at BNP Paribas Fortis and a co-author of the book that I'm currently reading called The New World Economy in 5 Trends: Investing in Times of Superinflation, Hyperinflation, and Climate Transition. Philippe, welcome to my show, and thank you for the great book you sent me.
thank you for having me. I'm very excited to have this conversation.
Same here. I have read 1/3 so far. Great reading. How did you decide to write this book together with Cohen Lou? And please share us your origin story, your background, please.
Well, it was basically Koen's idea to start the book. He already had written 4 or something. This is my first book. He always says I've worked 3 years on it and you about 3 months, which is correct. But then I always say, well, it's the first book they've written that's a little bit readable. And so if I can orient the audience a little bit, look at the blue pages because they're mine. Oh, that's a joke. But we had the feeling that the world was profoundly changing. Since COVID, and we do not think that COVID was really the cause, but it was a catalysator. So it was something that put the thing in motion and made it go faster, a catalyst, I should say. And that was the idea. And we saw a number of trends changing, like aging, like multi-globalization, which means in a way less globalization or a different kind of globalization. We have the climate change, we had the innovation. So a lot of things were changing. And that's led us to believe that we're now in an environment that looks way more like the 60s and the 70s, like the period from 82 until recently, which means in a world where inflation, interest rates, and commodity prices, for example, are structurally higher. And that's a totally different world to live in for consumers, for investors, for companies. So we thought, let's do that. And well, it's also a book because Koen and I, as you've probably already read, we have same view on a number of things, but we also disagree on a number of things. And that's maybe unique about the book, that you get the 2 perspectives. And it's also an invitation for readers to get into the discussion because nobody knows what will happen in 20 years' time. We have articulated a view on the world. We believe that that's exactly what's going to happen because also with the elections of Donald Trump. And so we see a number of things happening that we have written down in the book, but still it's a discussion, and that's an invite to a discussion. In terms of origin story, well, I've been in banking my entire life. I started to look at equity markets when I was 12 years old. So that's already, I made every mistake in the book. So when experience is an accumulation of mistakes, well, I have a lot of experience in that. So I've been in banking, economics, strategy for my entire life. And people can follow me also on the social media. I have a reading contest. I have over my shoulder. I try to read a book each and every week, excuse me. And our book is also a book about books because we talk a lot about books in that. So I've been a banker for my entire life. I've been looking at the world my entire life. Yeah, that's a little bit my origin story. That's pretty boring, but I love it.
No, it's not boring. It's actually very interesting. Here is your book. Like I said, I read so far 1/3 and plan to finish it in the next couple of days. Like you said, the book is divided in 5 mentioned trends, chapters, whatever you want to call it: innovation and productivity, climate debt, multi-globalization, and the final one is aging, right?
Yeah.
I would like to cover all 5, but before we do that, I would like to hear your helicopter view on the world economy today and where is it going tomorrow, looking ahead, going forward. What is important to know with the trends, with the things that happen right now in the economy and what will happen?
Well, in the short run is always complicated. So a longer term view, and I will come back to the shorter term view in a second, because I think there is a massive opportunity there. The longer view of this book is indeed that you live in this world of higher inflation, higher interest rates, higher commodity prices, which resembles the 60s and the 70s. But of course, within these 30, 40 years time frames, you have cycles. And at this moment, it looked like the cycle was turning down. So where the opportunity lies for investors and then for companies, let me start with companies, if you indeed believe that interest rates and commodity prices and inflation will be higher for the next many years, but the cycle drives these down, well, there's an opportunity to hedge that. To companies, we already say hedge your inflation, hedge your wages, hedge your interest rate. If you have an investment project coming up in the next 3-4 years, well, make sure that your capital is there, that your financing is done. So that's one thing. For investors, this means basically that you have to invest in real assets. And there I have one of my favorite stories. I must first say, Koen is a very good friend of mine. He's a dear friend of mine. I see him more than I see my wife, but we're very often making fun of each other. So you will see that. And I feel a bit bad because he's not here to defend himself today. But the chapter about that he has written, and it's the most thoroughly researched chapter in the entire book. It's about 50 to 60 pages, but it does not make you very happy, because we try to have an optimistic book. But okay, if you look at the debt situation in the entire world, it's not a pretty story. But I have only four pages on that one. And then I say to investors, okay, and that's the idea of the book. How should we position? Because we can all say that the world is going to end, but okay, what's the solution? And for an investor, I think the solution is very clear. And I compare that with the game of Monopoly. And we have all played Monopoly when we were kids and when we studied, and with our kids and or even our grandchildren at a certain moment in time. And in Monopoly, there are basically two scenarios possible. First scenario is, for whatever reason, sometimes just dumb luck, somebody holds the expensive streets. In our game, to be the same in your place of the world, I think, the blue one, the green one, the yellow one. But somebody hold those streets, well, the game is fairly quickly over. But it can also be, and that's another scenario, that is evenly divided. Everybody holds a bit of the board, but nobody has the upper hand. And then you realize at 11 in the evening, and you played a number of hours, that because every time you pass through go, you get money, that all the money of the bank lies on the table. And of course, you do not want to stop because you want somebody to win. And then you have another beer, another bottle of wine. And then somebody smart, usually a woman, says, okay, let's make little papers and write 100 and 200 and 300 on them. And we recapitalize the bank and we play on. But then it's 3 o'clock in the morning and the same thing has happened. All the money is again on the table. And the pile of money is even bigger. And that's what I say, and that's my 5 cents in that chapter. In Monopoly, in investments, and in life, it's not so much important how much money is on the table. It is important who owns the streets, the hotels, and the street and the land, hotels, the houses, the streets, and so on. And who owns the real assets? Who owns the equities? Who owns the companies? Who owns the pigeons? In Belgium, they play with the pigeons. Who owns the wine? Who owns the old timers? Who owns the gold, the silver, the commodities? And we will be living in a world where real assets become even more important because inflation is so high. And come back to your question, because I'm really going to answer that. Sorry that I beat around the bush a little bit. In the short term, maybe it's going to change with the elections, because if Donald Trump starts to stimulate the economy, all of a sudden the process will be quicker. But we thought up until now that we were more in some sort of a slowdown, lower inflation, lower interest rates, and that offers a window of opportunity to buy these assets, to make sure that you have enough debt, to make sure that you do not have too much cash, because the world that comes after that, and I have way more confidence to hear that on the longer term than the shorter term, because this has been one of the most difficult cycles to read that I've ever seen. But still, there is the opportunity. So if you ask me with a gun to my head, long term, I'm confident in the world that I see. Short term, I would say it is still slowing down a little bit, but I have less confidence on that than before because we have these elections and probably the fiscal stimulus we will see in the United States will be bigger than we thought before.
Yeah, great point and analogy on the monopoly, and agreed 100% hard assets. You have to own hard assets in the times that are coming, and those times could be very bad times, unfortunately. But what would you say? You named some real estate, gold, and some other hard assets. How would you prioritize them? What to hold first? Then second, third, fourth?
Well, that's a difficult one because that depends a little bit on the risk appetite of everybody. I'm not going to buy pigeons, but I know somebody who has a lot of pigeons, so it depends a little bit. But I think in each and every portfolio, you should first own a nice piece of real estate. And you should clearly have enough loans against that because central banks will try to inflate the debt away. You have a debt problem that's massive worldwide. So the only way not to get rid of it, because you will never get rid of it, but to keep it manageable is let inflation run. So that's what they're going to do. And they're not going to run it at 8 or 9% because you cannot sell that to the population, but they will try to let it run at 3-4% and tell everybody that the 3 or 4 is 2. And they will tell that in a very easy way because they will say, look, we want 2% on average, but since it was so low for so long, well, now we can have a little bit more. So that's what they're going to do. And they will try to inflate the debt away. They can do a lot of things, but they cannot inflate their debt away or debt not away. So it's all or nothing. So if they indeed create the inflation, cash will become less valuable, but also the real value of debt will decrease as well. So a nice piece of real estate with a nice loan against it would be one. A second one would certainly be the equity market, even though if you look at the S&P and some others, they are at very high levels. So, of course, also because they have the Magnificent Seven story in the United States. You have a lot of leverage. You have interest rates. You have quantitative easing. So you had a lot of money flow. So I would clearly always, I'm a big fan of what Warren Buffett always said, you want to own businesses, you want to own companies directly through your own business or indirectly through the stock market, because in the long run they create value. The only little caveat I would make there is that stock markets have gone up, especially in the United States, for quite a while and are quite expensive. But still, that would something I would be looking at. Thirdly, I would certainly look at the precious metals market as well. I think gold is a nice run. In the book, we had a target for gold of 4,000. Back then, it was 1,600. Everybody said you're absolutely crazy. Now at 2,600, okay, it's already a little bit closer. I think if the world develops as I think it will develop, I think 4,000 is even a conservative number. I think over the years it will go higher. They always say gold can double. You say, well, what are you talking about? But if you look at when Bretton Woods fell, gold was at 35. Then it went to 70. Then it went to 140, to 80, 560, above 1,000, above 2,000. So it already doubled 6 times. Why should it not double 7 times? So that's something I would look at. I would look at silver as well. Silver has lagged gold badly. And then, of course, after that, it becomes a little bit personal preferences. I like wine. So that would be one. But wine is a problem because if you want to resell it, you have to prove that it was held in an optimal condition and so on. So that's difficult. I'm also a lover of artworks, but art market is complicated. You have to know it a little bit. Some things go up in value a lot, some decrease in value. If you look, for example, at these furniture, Japanese furniture that went for a lot of money 20, 30 years ago. Today they sell it at the price of firewood almost. So that can happen as well. But I would certainly have real estate. I would have companies. I would have some precious metals. And after that, I would say it's a little bit your preference.
I really like your answer, especially the part when you said wines. Let's go a little bit off topic. And what kind of wines do you like? And what wines should be a great investment?
Well, I'm not a real connoisseur, as they say, but I like wines. What you typically buy then, but it's also a little bit big cap, small cap story. And so you have the typical French, Italian, but especially the French wines. Everybody knows they go up in value a lot. So I would probably, just like in art, if I were to invest in these things, I would find somebody who could counsel me to say, do this and do that. But like I said, it's also a question of being able to prove that you held them in optimal conditions. Now, that's the new world. I don't remember exactly what the name of the company is, but you have a company these days that where you can buy wine and they also stock it for you. And they quote wine in bid and offer with a reasonably big spread, but you can immediately, you would lose about 7% if you would buy and sell immediately, but still if you do it for a number of years. And then, of course, you have the guarantee that it is basically, in the optimal conditions and you can sell it again. But a lot of investors do, or people who like wine, they buy a couple of bottles of Petrus or whatever expensive wine. They let it go up in value, which it always does in the long run. And then they buy 3 cases, for example, or 4, and they use 1, and the rest they sell for the investments that they have made. And then you have good wine, and you don't have to find it horrible that you pay a lot of money for the wine because it's profit. So that's the way that I look at it. Then, of course, you have the real guys who know these things. I know some people who look in Switzerland and so on, it's wine that's not really on the market because there is not a lot of it. But if you can, of course, find a new thing, well, that's that of course, but that's like in small caps. You can buy either the things, you can buy the Microsofts or the IBMs, and your risks are a little bit lower, or you can try to search in the Russell 2000, and then it can go either way. But it's also fun to try to find new things. But I'm not an investor in wine. I'm somebody who likes it, but I know people who did very well. And what's very interesting is that the prices of good wines have gone up, in fact, more than equities over the many years. Now, it's not a very good diversification in the sense that typically when equities go up, wine goes up as well. So it would even be nicer if they would move in the opposite way from time to time, because then you would have a diversification effect that you don't have. But still, I can see that I see your eyes glowing when we talk about wine. I think
I like wine, and I always love to learn something new. And I did actually learn something new about this vehicle that you can buy wine and hold wines, something like Sprott in silver and gold.
Yeah, it's exactly that. It's exactly that. It's
I
don't know the name, but I will look it up.
Yeah, please give me the names when you do. Please send me. I have to know about. I didn't know about this. This is the first, so very, very interesting. Okay, I was lying. I read 1/3 of your book, but I skipped to the part about debt. I really was intrigued by the headline, and I want to know. There are really few interesting topics to touch on debt, but my question would be, what can we learn from the past about debt, and how can the strongest economies and the ones with the highest debt change monetary policy? What's your take on that?
Well, to be blunt, if you look how it ended with debt, typically it does not end very well. That's always that's one thing that comes back in history, and then
of course,
go back to Roman times. You can go to the French kings, to the Louis 14 and 15, and so typically there is one book, and like I said, all book is a book about books, so we mention a lot of them. I don't know whether we really mentioned this one, but you have this book by Steinhardt and Rogoff. This time it's different, which describes, in fact, the history of debt since the 1500s. And typically, well, it does not end too well. So the question is, how do you get rid of debt? And then I will come back to central banks. How do you get rid of debt? Well, you can try to save your way out of it or grow your way out of it. No, that's the hard way. You do austerity, you try to, with innovation and stuff, you try to grow your economy faster. But that's in practice reasonably difficult to do, especially in a fourth turning, because a fourth turning is a period we live in today. And that's once again a book which was by Strauss and how 30, 40 years ago, but recently we had an update. The fourth turning is here by Neil Howe. I always say that's not a book at the swimming pool. That's not a book under the Christmas tree because it will depress you very much. But it's a good book. It's a good book for Halloween, so we're not too far from that. So that's a good book to read. But that's the fourth turning is a world where you have conflicts, unfortunately, within countries, between countries. So it's extremely hard to sell the tough messages to the population because they will not vote for you. So saving your way out of it, growing your way out of it, very complicated. Second way to solve it, between brackets, because it's not really a solution, you just default on it. That is what happened many times in the past. They restructured the debt, they defaulted debt, they devalued the currency, whatever. So that's also a way to solve it, but it's highly disruptive for the world economy and for the world markets, because it's not only the debt that disappears, but the debt is, of course, also the asset of somebody, and you take that away. That's already very painful, but the guy who suffers the loss is going to look at his entire portfolio, say what else will go down, will start to sell everything, and then you get a financial crisis. So that's not really the option you're looking for. And then the third way, and then I come to the central banks, is inflate your way out of it. Just let inflation run some more. And if you let inflation run 3 to 4%, and I'm not an advocate of that, I'm not saying that you should do that, I should not say that I'm extremely excited or happy about it, but of all the bad situations, of all the bad options that are on the table, let inflation run a little bit, and not at 8 or 9, because that you cannot sell to your population, but at 3 and 4 and you sell it for 2, well, then you inflate the debt away, but you also inflate the cash away. And like we said, for companies, make sure that you have your financing in order, that your hedges in order, and as an investor, think about monopoly, make sure that you have real assets. And eventually, I think that's what central banks will do. Even though they have a mandate for 2%, and I think in ECB in Europe, they will be more stringent, because we have Germany that is very, very sensitive to inflation. In the US, with the Donald Trump, who's going to spend on the fiscal side, but also put probably pressure on the Federal Reserve on the monetary side. We should not forget that the mandate of Jerome Powell ends in May 2026, and then Donald Trump can appoint whoever he wants. I think there will be some pressure to ease monetary policy, even though inflation is still high or too high, and then we will be very quickly in the inflationary world that we talk about.
Yeah, good point as well. You mentioned equities as a good thing to hold. Personally, where do you hold? What kind of equities do you personally hold? Is it the blue chips, the big ones, or some lower scale? What commodities, stocks, if you can expand on that?
Commodities, certainly. I will come to that. Now, that's a very good question. To be honest, that's the big discussion we had in our investment committee the last 2 years. And it's a very difficult question, because the question becomes very quickly, how much US do you hold and how much of all the rest do you hold? And the same question is almost of the Magnificent Seven, of the technology that you hold, because the Magnificent Seven is already 37 or so % of the entire S&P. And yeah, especially in 2023, that was an issue, because if you did not hold enough Magnificent Seven, well, yeah, you were lagging. And then your client would say, look, the S&P went up 15% because of these Magnificent Seven stocks. I do not have them. I have 2% return on my portfolio. How come? And then the easy way to go was, okay, let's have enough Magnificent Seven, which means that there was a massive flow of the entire world into these names, went up, and yeah, you get a self-fulfilling prophecy. And the same question is today on the table again. What do you do? Because also this year they've done well. We have seen a bit of broadening in the market. So in 2024, it's not so extreme anymore. So the rest has done also reasonably well. But you still have this American exceptionalism where these stocks keep going up. And the US is about 30% of the world GDP, but about 70% of the market cap. So there is somewhere a mismatch, but that mismatch is already going on since 2008, 2009. So if you've been waiting for a reversal, you're already waiting almost 20 years for that. So people are giving up. And that is maybe the opportunity. So what we try to do in the portfolio is to have a good equilibrium, to make sure that we have enough of the tech, that we cannot run around behind the benchmark for too much, but still try to look for opportunities elsewhere, because some other parts of the market are fairly cheap. Some parts in Europe are very cheap, maybe for a reason. The Russell 2000 is way cheaper. Yesterday, with the Trump election, the Russell went up more because they think that the small caps will benefit more from the measures that are taken into the economy, of the tax cuts, maybe of the protectionism, of the tariffs, so that it will benefit the American small caps more. So I would strive to have a good equilibrium. Since I believe, and that was to your question, since I believe that we've just started the largest bull market in commodity in history, it is only the very first inning. I think that commodity-related stocks will also do well. They will be very volatile, and we know that.
Agreed on the commodity bull cycle. I call that as well. But are you afraid of the global meltdown, of the market crash? We have like 15, 16 years of uptrend, except the COVID downturn. Dow Jones, the big indices, they're up like 15 years of going up. Yeah. Do you believe that we could see really some market crash, or let's say some form of correction, maybe, because we didn't see it? We had this one during the COVID time, but beside that, we didn't have any.
No, that's correct. We have to go back then to 2008, 2009, the financial crisis. It was the last one, and before it was 2000, and then the real estate crisis. So it has indeed been a while now. COVID was pretty tough, but it was corrected to the upside fairly quickly because central banks, that's one we called, by the way. We from lockdown, we had conversations with our clients, we laid middle films, we wrote documents saying, buy this with two hands. We don't know where the bottom is because central banks will come in and they will flood the world with liquidity, and then things will go up like hell. And they went up even more than we thought because it was a straight line up. And since then, we have some correction, some stabilization, but indeed nothing serious. And the market has been going up for quite a while. So corrections are always possible. Where do I see the risk? Well, if we are correct in this world where inflation and interest rates will be materially higher, we always say, and we write it in the book as well, that we think that interest rates are like gravity. When interest rates are zero or negative, you have negative gravity or zero gravity, so anything can fly. So I'm not so worried when the economy slows down, because typically the stock market is not correlated with the economic cycle, but it's more correlated with the interest rate cycle. So if the last 30 years, you bought each and every time that the economy was strong and sold when the economy was weak, your timing was absolutely wrong, because each and every time it was weak, interest rates went down and you made money. Each and every time it was too strong, interest rates went up and you lost money. And there is maybe the risk more today than a couple of days ago, but indeed you get this massive stimulus in the United States, and interest rates and inflation goes up to 3-4%, and instead of a rate cutting cycle, which is priced in, we get rates that stay stable or start to go up. Well, you have an issue, and that's in my mind the biggest risk. If you were 4.5 on the 10-year American now, if you were to say to me it goes to 6 or to 7, I would be worried that could be the trigger for some more severe correction. Now, mind you, in the long run, I look in equity markets since I was 12 years old. I'm not a butcher who's going to say that meat is unhealthy for you. But if you ask me and that can be a shock. Tomorrow you can have another pandemic, you can have another war. So shocks are very difficult to predict. But if you, in the normal flow of things, what would worry me is that interest rates go up too much. That could be a catalyst for a correction.
Right. I liked very much the part in your book called Characteristics of the Digital Revolution, and the part that you're writing about artificial intelligence future and how to invest in in AI. What's your take on the AI coming to our lives more and more, and how should we play the AI story in our businesses, life, and in investing?
Well, that's a little bit the same answer, and allow me to illustrate it with an example as well, because we already talked about monopoly. Let us talk about chess a little bit in a second. But indeed, up until now, the money has been flowing to the pick and shovel makers, to the NVIDIAs who built it. They always say you do not necessarily have to invest in the gold mine itself, but invest in the people who supply the shovels and the things to do the mining. And that's in that world is NVIDIA, because they supply the chips that make the AI run. And there's a little bit same thing as Cisco was back in 2000. They made the routers and then the switches that makes the internet possible. So but that also was a stock at a certain moment in time where you say it's a no-brainer, invest in this. But if you look at NVIDIA, it's about 40 times not earnings but revenues. And that's exactly the same as the peak valuation that Cisco had in 2000. And that became dead money after that for 10 years or 15 years or so. So you run that risk. Now, in the book, and that's an example that Koen has written in the book, because he recently had a study trip to India. And he came back with the story of a chessboard. We already have Monopoly, but talk chess for a moment. The chessboard was invented in India. And the inventor of the chessboard went with it to the emperor in Pataliputra, capital back then. And he showed the board and he said to the emperor, I have invented this and it works like this and it has kings and pawns and what have you. And the emperor was extremely happy and he said, fantastic, I want to reward you. What do you want? And he said, I'm just a poor guy. I don't need too much money. Just give me some rice. And they said, how much rice do you want? And then he said, okay, put 1 grain of rice on the first square, 2 on the second, 4 on the third, 8 on the fourth, and just do the entire chessboard like that. Now there are 64 squares. Square 32 is a very important one, a very interesting one, because it's the middle of the board. The middle of the board, the emperor already had to pay the inventor 5 billion grains. That's still imaginable. I'm a banker, so I can work with big numbers. 5 million is a very, very big rice field, but it's still imaginable. Now, the 32nd square is a very interesting one, because there are 2 ideas that are still compatible. The emperor is still emperor, and the inventor, still has his head. If you go to the second part of the board, then you enter in Alice in Wonderland or the Matrix. The 2 are no longer possible, because either the emperor gives an entire empire to the inventor, or the poor man's head is chopped off. Of course, we know from history what happened. The poor man's head was chopped off, and the emperor stayed emperor. But if we take that idea back to NVIDIA, it's 40 times sales, not 40 times earnings. But if you grow, you double your profits, and they're doubling, more than doubling their profits. Well, in 1 year time, it's 20 times sales. Then it's 10 times sales, 5 times sales. Now, I know you cannot double it infinitely, because then in 10 years' time, NVIDIA would be bigger than the United States. And in 20 times NVIDIA would be bigger than the entire world. But the question is, how many years can you do that? And in that way, I want to have an open mind, and we're not telling clients to sell all these magnificent 7, because we know that people are very poor in judging exponential growth. We think linear. Exponential growth is difficult for us. But like I said before, with asset allocation, we try to hold some of these names, but we try to look at others as well. And that was also what we tried to do in the artificial intelligence space. We look for companies that are not necessarily AI companies, but are regular companies that integrate the technology. And if you want innovation, the pickup in innovation that AI is promising, it should leave the technology space and it should move to the entire economy. And there we can find opportunities indirectly, and we'll like that because we get back to the commodity space. Copper and other things are indirect ways of investing in AI because you need electricity transportation that copper does. You need also a lot of energy. ChatGPT uses 28 times as much than in a Google search. So you need data centers, you need energy. So energy and commodities are an indirect, cheap way of investing in AI. But I think we should find a good equilibrium.
Yeah, and there will be no AI without nuclear energy, in my belief. But that's another topic to cover. Let's wrap it up for today. I would like if we could have a part two of this interview. We have a lot of topics more to discuss. Philippe, how can people reach out to you, and where can they buy your book?
Well, book is basically everywhere on Amazon and some other online bookstores, but Amazon would be an easy one. And yeah, I'm on LinkedIn, so people are very happy to follow me and then to interact because I interact a lot on social media. I try to post things. I post podcasts like we do today. So I think it's a very good medium to interact. So yeah, our book is a very good starting point. This podcast is a very good starting point, and it's very nice that you mentioned uranium because that's also one of my topics. So let's indeed the fact that Bill Gates restarted 3 Mile Island in the United States is a clear example. I think that this is a very big wave that's coming, but maybe let's keep that for next time.
Agreed. Philip, thank you very much for coming to my show. Looking forward to host you again, and best of luck to you.
Best of luck, and thank you very much for having me. Have a great day.